Hi, everyone. This is just a mini lecture to cover the week 2 information, which is chapters 3 and 4. If you look from the professor discussion, you're going to also see that I've included some additional study guides to go through with that. But let me just share my screen. Okay, so for this problem, just starting out, it's just a problem I created just to kind of walk you through the concepts of adjusting entries and closing entries. If you look, this is my trial balance on January 31st, 2023, and these are the different adjusting entries I have to make. So first, an inventory count of supplies at the close of business on January 31st reveals 700 of supplies are still on hand. You look at that trial balance, supplies were 1,000. Well, if we end up with 700 at the end, how much of supplies did we use? Has to be 300, right? And sometimes it's easier to look at a T account when you're thinking of these things. So let me just take you to a T account. And what you can do, I didn't do T accounts for everything, but what you can do is you can keep a sheet of paper on the side when you're doing this and go through T accounts just to kind of help. But the supplies was 1,000. I'm crediting it for 300 so that I get an ending balance of 700. I'm debiting supplies expense for that 300 in supplies I've used. So going back to the practice problem, if you were to look at, again, here's the entry, debiting supplies expense, crediting supplies to record the supplies I've used. If you look at that adjusted trial balance that I create later, you'll see the supplies account is now 700, and I have added a supplies expense account of 300. Next item is Bob purchased a 1-year insurance policy on January 1st for $1,200. 1 month of insurance has expired. So to figure out what it is per month, I just take that 1,200 that it had cost me and I divide it by 12 months, which is 100 per month. So if you look at that trial balance, you'll see that prepaid insurance was 1,200. I'm going to be reducing that. So now I actually have an insurance expense of $100, and I'm going to reduce prepaid insurance by crediting it for 100. So let me show you again, T account for this. If I had 1,200, which is what I did have, and I reduce that by crediting it 100, my ending balance is 1,100. And then here's the insurance expense. Let me show you the adjusted trial balance that would be created after this. So here we had originally prepaid insurance is 1,200. Adjusted trial balance, that prepaid insurance is now 1,100. And I have my insurance expense right here of $100. Next, the equipment Bob purchased has a useful life of 20 months, no residual value. So to figure out the depreciation per month, it's going to be 5,000 divided by 20 months, which is 250 a month. For that, I'm going to debit an account called depreciation expense, which is $250, and eventually that flows through onto the income statement. And I'm going to credit an account called accumulated depreciation equipment for $250. Accumulated depreciation for equipment eventually goes into the balance sheet, and it is a contra asset account. So it reduces that asset account equipment. So if you look originally, I do have the office equipment of 5,000. If you look at the adjusted trial balance I would create, that office equipment does not change. It's still 5,000. However, I now have depreciation expense added of 250. And I have accumulated depreciation credited for 250 in that adjusted trial balance. Next one, on January 31st, Bob performed services of 6,000 to C Company for which he had received an advance fee on January 27th. So if you look at this initial trial balance, I had 10,000 in unearned service revenue. I've now earned some of that, right? So I have to reduce it. And since I've earned it, what I have to increase is service revenue. So if I look at the adjusting entry for that, I'm going to debit unearned service revenue for $6,000. The reason for that is initially that unearned service or unearned revenue would have had a credit balance. To reduce it, I need to debit it. And I'm going to add 2 service revenue, so I want to credit that for $6,000. So if I look at the T account again, I just think sometimes it's easier to keep track of a T account. If I look at that T account, you will see here was my unearned service revenue. Initially it's 10,000, debited it for 6,000. You have an ending balance of 4,000. My service revenue is 20,000. I'm adding 6,000 to that for an ending balance of 26,000. Okay, let me go back to the problem. Next thing I have is Bob owes 1 month of interest for a 1 year no payable. No payable is $1,000 and the interest rate is 5%, and he entered into it January 1st. So I need to figure out the monthly interest. To do that, this is 1 month of interest. It's going to be 1,000 times 5% times 112, because this is a 1 year no payable. If I multiplied that out, it would be $4.17. I'm rounding that to $4 just because it's easier to just deal in whole dollars, of course. But if, of course, on my initial trial balance, I didn't have that. Now I'm incurring that expense, so I need to record that interest expense with a debit and interest payable with a credit of $4. And you'll see that on the adjusted trial balance. Here's that debited interest expense for $4 and my credited interest payable for $4. Next item, last item, Bob's employee has accrued 7 days that has not yet been paid. The employee earns $300 per day, which is, to calculate that out, 300 times 7 is 2,100. Now, if you look, there is no salaries payable in this trial balance, the initial trial balance, but there is a salaries expense of 3,000. So when I, to record it again, debiting salaries expense, crediting salaries payable for 2,100. If I look at this on a T account, initially that salaries expense on that trial balance was 3,000. I'm adding 2,100 to it. So I now have a debit balance of 5,100. So my salaries expense on that adjusted trial balance will be 5,100. And I'm crediting salaries payable for 2,100, which will be the balance on that trial balance. Let me stop my share, go back. So if you look at the adjustment, of course, it was salaries expense a debit, salaries payable a credit for 2,100. This initial balance, remember I showed you this, the salaries expense was 3,000. If you look at the adjusted trial balance, that salaries expense is now 5,100, and I've added a salaries payable with a credit in that adjusted trial balance of 2,100. So you can go through this on your own and look at it item by item. But what we can now do is work off that adjusted trial balance to create financial statements. So the first statement I'm creating is my income statement that starts with service revenue and goes through the expenses till the end. So here you can see I've got my revenue account. I've got all my expense accounts. And if I total that expense account, it's 7,754. So my 26,000 of revenues minus 7,754 of expenses totals $18,246. For my owner's equity statement, it started out at 0, and then I had, and you'll see this is the same on the trial balance and the adjusted trial balance. My capital account is 20,000, so I made those investments during the month. So if I have 20,000 and I add in my net income, which I just determined here, I get a total of 38,246. I'm then going to subtract my drawings of 5,000, and that gives me a capital balance at January 31st. Sorry, this should say 2023. At January 31st, 2023 of $33,246. So if you look, you'll see in that actually the drawings in both the adjusted trial balance and the trial balance were 5,000. So what I would do next is create my balance sheet. And the balance sheet, if you look at that adjusted trial balance, those balance sheet items are going to be all of these items. So we're going to transfer these onto the balance sheet. The one thing we're going to have to do, though, is adjust BOD capital. So if you'll look, you'll see I transferred all these items onto the balance sheet, and I just had to change my capital account because I just determined that my capital account at the end of the period was $33,246. So that's where it is there. So you can go through that again on your own and check those. What I'm going to now do is I am going to close these entries. So I'm going to do all my closing entries. And what I'm going to do is close my revenues and my expenses to an account called an income summary account. So since normally, of course, my revenue account has a credit balance, to close it, I need to debit it. So I'm going to debit service revenue for $26,000. I'm going to credit income summary to close that account. My expenses, and you would pull this, you can pull these right off the income statement. To close my expense accounts, since they normally have a debit balance, I close them by crediting them all. I total them, and then I debit income summary for that total of expenses. So what we're doing with these closing entries, we're closing our temporary accounts. Those are our revenue accounts, our expense accounts, and our dividends. I'm going to take the difference between the two. So I had $26,000 minus $7,754. If I do the math there, that ends up being $18,246. And that I didn't create a T account for that, but had I would have had a credit balance in income summary of $18,246. I now need to close that income summary account. Since it has a credit balance, I would close it with a debit. So I'm going to debit income summary for $18,246, and I credit that to BOD capital. And what that does now, I've closed out all my revenue accounts, closed out my expense accounts, and I've closed out income summary. The last thing I have to do is close out my drawings. So the way I do that is I'm going to, since my owner's drawings normally has a debit balance, I'm closing it out with a credit. So I'm going to credit owner's drawings for $5,000. I am debiting my capital account for $5,000. And that is it. So if you have any questions, feel free to call me. But hopefully that'll answer, give you a process of how you go through these closing entries and adjusting entries and create your adjusted trial balance. Have a great week, everyone. Bye.